Most traders online will tell you that you have to aim for 3 times your risk on every trade. Risk 1 to make 3. They repeat it like a religion. It sounds smart, it looks amazing on a screenshot, and it makes people feel like they found a cheat code. But here is the uncomfortable question nobody really asks. If this 3-to-1 reward is so perfect, why are most new traders who chase it still losing money, blowing up accounts, and quitting? There is a reason, and it is not what you think. The truth is that for most regular, small retail traders, a simple 1-to-1 risk-to-reward ratio often beats that fancy 3-to-1 dream, especially in real life, with real emotions and real imperfections. And once you see why, you might never look at your targets the same way again. Imagine this: you risk $100 on a trade. With a 3-to-1 idea, you are trying to make $300. Sounds amazing. You think, I only need to win a few trades, and I am good. But then you watch price come close to your target, almost there, 80% of the way, and then boom, it reverses and stops you out. You were right on direction, right on entry, but your target was in another universe. Now rewind and imagine the same trade, same entry, same risk, but your target is $100 instead of $300. Price moves in your favor, reaches that level, you take the win, and you are out before the chaos. On a backtest spreadsheet, 3-to-1 looks godlike. In your actual brain, with your actual nerves and your actual need to pay rent, 1-to-1 is often the silent hero. Let me tell you a story that will make this real. There are 2 traders. We will call them Max and Leo. They start with the same capital, the same strategy, the same chart, even the same broker. The only difference is how they set their targets. Max is in love with the idea of big winners. He follows every trading quote page on social media. He repeats that line, "Let your winners run." So he decides he will only ever trade if he can see at least 3 times his risk in potential profit. Leo, on the other hand, is almost boring. He decides he will aim for about the same amount that he risks. If he risks 100, he wants to make roughly 100. And he is more focused on following his plan than flexing his risk-to-reward ratio in a screenshot. Day 1. Both see the same setup on Bitcoin. Price pulls back into a level, gives a nice clear entry. They both risk $100. Max places his target way up there, $300 away. Leo places his closer, $100 away. Price moves up. It runs, it hesitates. It pulls back a bit, then continues. Leo's target is hit first. 1 clean win, plus $100. He closes his platform, makes a coffee, and journals the trade. Max is still in. Price gets close to his 300 target, wicks near it, then starts to stall. He watches the candles shrink. He feels that tightness in his chest. He thinks, do not close early. Trust the process. Big winners, big winners. Price then snaps down, erases 2 hours of movement in 2 minutes, and slams his stop loss. Max finishes the day with minus 100 while Leo finishes with plus 100, and they both traded the exact same idea. Now multiply that dynamic by weeks and months of trading. Max's chart is filled with almost wins and painful reversals. He has a few huge winners that make him feel like a genius, but long stretches of frustration that slowly break his discipline. Leo's chart is filled with many small, controlled wins and clean, understandable losses. Nothing looks impressive in isolation, but the overall equity curve is smoother, calmer, more consistent. On social media, Max looks better on the days his 3-to-1 trades hit, but in a broker statement, Leo quietly wins. Here is where people get it wrong. They think this is an argument against large targets or against big moves. It is not. It is an argument for matching your targets to your actual skill level, your actual strategy, and your actual psychology as a small retail trader. If you are consistently failing to hold for 3 times your risk, the problem is not that you are weak. The problem is that the game you are trying to play is not designed for where you are right now. Let us look at the numbers for a second, because numbers expose the truth. Imagine you take 10 trades. With a 1-to-1 risk to reward, if you win 6 and lose 4, here is what happens. Each win makes you $100. 6 wins give you $600. Each loss takes $100. 4 losses take $400. 600 minus 400 leaves plus 200. You win more than you lose and you end up profitable. You do not need to be a genius. You just need to be slightly better than a coin flip and keep your losses the same size as your gains. Now imagine the 3-to-1 dream, 10 trades again. If you win 3 trades and lose 7, the math looks like this. Each win is 300. 3 wins give you 900. Each loss is 100. 7 losses take 700. 900 minus 700 is also plus 200. Sounds equal on paper, right? But here is the key. That 3 wins out of 10 requires you to sit through 7 losers. 7 trades that did not work. 7 emotional hits. 7 chances to break your rules, revenge trade, double size, or change strategy. On the chart, it is just 7 red markers. In your brain, it is a storm. And that is the best case. What happens if you slip slightly? What if instead of 3 wins out of 10, you only manage 2? Now it is $600 in wins minus 800 in losses, and you are down 200. You only dropped 1 single winning trade from your statistics, but your account flipped from green to red. That is how fragile this high reward idea can be when you mix it with normal human psychology. Most new traders do not have perfectly consistent entries. They do not have perfect discipline. They are still learning, still experimenting, still doubting themselves. For them, a model that depends on a low win rate but very big winners is like walking a tightrope over a canyon with no safety net. One wobble and you fall. The 1-to-1 approach is more forgiving. If you are wrong once in a while, the damage is contained. You can even be average and still grow as long as your process is solid. That is why for the majority of retail traders, especially in the beginning, the smaller, closer target often leads to better long-term outcomes. Now let us get even more real. Backtests and trading books do not include slippage, bad fills, panic closes, or the moment your internet dies for 30 seconds at the worst possible time. Real life does. When you shoot for 3 times your risk, your target is farther away. That means more time in the market, more time for news candles, more time for random spikes, more time for the coin to do something weird that has nothing to do with your edge. You are giving the market more opportunity to mess with you. With a 1-to-1 target, your trade usually resolves faster. In and out. Your exposure to nonsense is lower. There is also a huge hidden benefit, feedback. Leo, our 1-to-1 trader, gets more closed trades to study. Every trade gives him a full cycle. Entry, management, exit, result, review. That means more data, more patterns he can spot in his behavior, more chances to refine his edge. Max, the 3-to-1 hunter, spends more time sitting inside open trades, waiting. He ends the week with fewer closed positions, which means slower learning. People forget that your brain learns from repeated complete experiences. 1-to-1 gives you more of those reps. If you are still listening right now, you might be thinking, so should I never try to hold for big moves? That is not the message. The message is this: earn the right to hold for big moves by first proving that you can be consistent with smaller, more realistic ones. Think of it like the gym. You do not walk in on day 1 and try to deadlift 3 times your body weight. You start with something you can lift with good technique, rep after rep, until your body adapts. In trading, your mind is the muscle you are training. Shifting from chaos to a stable 1-to-1 approach is like picking a weight you can actually control. Let me show you how this plays out in the day of a typical retail trader. It is Monday morning. You open your platform, you check Bitcoin, Ethereum, maybe a couple of altcoins. You see price hovering near a level you planned the night before. Your rules say, wait for a clear break and retest or a clear rejection, then take the trade with 1-to-1. You watch the candles form, the move happens, it lines up, you take the entry. Your stop is a logical place where the idea is clearly wrong, not some random number. Your target is the next clean area of liquidity, not some fantasy line drawn miles away. Price moves in your favor, and within 20 minutes you're up 1 risk unit. Trade closed, you log it. You are done for the session, or you calmly look for the next setup. Same morning, different universe. In the 3-to-1 mindset, you take the same entry, but you leave the target at the extreme of the chart. price moves in your favor, reaches the level that would have given you a full 1-to-1 win, but you are still holding. You are thinking about the screenshot you will post if this hits, about how it will make up for all the losses last week. Then price stalls, pulls back, and now you are only up half your risk. You hesitate. Close now, and you feel like you broke your plan. Hold and you risk watching your unrealized profit vanish. You are no longer trading the chart. You are trading your own fear and greed. The more time you spend in that psychological wrestling match, the more likely you are to make a mistake. And trading, in the end, is not a game of perfect knowledge. It is a game of limiting mistakes. There is another angle almost nobody talks about: scalability. When you are on a small account, a $300 winner feels life-changing. But ask yourself this: if you cannot follow your plan for $100 or $200, how will you follow it when you are trading $10,000 positions? When the numbers get larger, your emotional responses get louder. A stable 1-to-1 framework builds the emotional callus you need for later. You learn to treat wins and losses as simple multiples of risk rather than dramatic events. I want to make one thing clear, because this is where people twist the message. I am not saying a 1-to-1 risk to reward ratio is some magic formula that automatically makes you profitable. It is not. If you take random trades with no edge and always use 1-to-1, you will still lose. The ratio is not the edge. Your system, your entries, your risk management, your discipline, that is the edge. The ratio is like the gear in a car. For a new driver, starting in a slightly lower gear is safer and more forgiving. Once you master the fundamentals, you can shift. So if you are watching this and wondering what to do next, here is a challenge that can actually change your trading. For the next 30 trades, lock in a simple rule. Every trade you take must have a clearly defined stop loss. Place that stop somewhere that actually invalidates your idea, not just where it feels comfortable. Then, set your target at approximately the same distance. If you risk $50, aim to make about 50. If you risk 100, aim to make about 100. During those 30 trades, do not move your target further just because the chart looks exciting. Do not turn a 1-to-1 trade into a giant home run fantasy. And just as important, do not cut your trade at half of your planned profit just because you are scared to give anything back. Let the statistics play out. After those 30 trades, sit down with your journal, count how many winners you had, count how many losers, look at your net. You might be shocked by how much calmer you felt, how much more predictable the process became. You may not have crazy, story-worthy winners, but you will have something far more powerful: clarity. If your win rate is above 50% with 1-to-1, you have a foundation. You can consider experimenting with slightly larger targets on very clean setups, maybe 1.5 times your risk or 2 times your risk on the best days. If your win rate is below 50%, you have a clear signal that you need to improve your entries, your timing, or your patience, instead of just stretching your targets further and praying. Ask yourself this final question: are you trading to impress people on social media, or are you trading to actually grow your account over the next 5 years? Because those two goals do not always match. The screenshots that get the most likes are the huge risk to reward wins that happen once in a while. The accounts that survive are usually built on boring, repeatable, almost unremarkable trades stacked over time. So when you hear someone online shout that 3-to-1 is the only way, remember Max and Leo. Remember the difference between a mathematical model and a real human sitting at a screen. And remember this simple idea. For most retail traders, especially when you are still proving yourself, a realistic 1-to-1 risk to reward ratio combined with a real edge and real discipline will quietly beat the dream of giant winners that almost never hit. And if this message annoyed you a little, that is probably a sign you needed to hear it.